All right, everyone, before we jump in, I just want to acknowledge the preparation behind today's session. We've combined deep subject matter expertise with a little bit of AI support to build a really comprehensive look at a crucial topic for all of you.
Welcome, class! Today, we are laying a massive cornerstone for your future careers. Seriously, we're going to go deep on a topic that is absolutely essential for anyone advising Canadian businesses, and that is the Canadian Controlled Private Corporation, or CCPC, as you'll hear it called constantly.
So before we get into the weeds, let's just frame this with a question. I want you to think for a second. Think about all the thousands of startups, family businesses, and growing companies all across Canada. What's the one structure that underpins almost all of their tax planning?
Well, the answer is the CCPC. This is a cornerstone of our tax system. You're going to see this day in and day out in your careers. So let me be clear. Understanding its nuances isn't just a good idea, it's an absolute prerequisite for being an effective tax advisor in this country.
Okay, let's dive right in. First things first, we have to understand the fundamental definition. What exactly is a CCPC? What makes a corporation qualify for this very special status? The legal definition, you can find it right in subsection 125-7 of the Income Tax Act. Now, notice what it doesn't say. It doesn't actually say who has to control the company. Instead, it tells you who cannot control it. And that right there, that is the crucial point, this whole concept of control. So, to qualify, a corporation has to meet all four of these conditions at the end of its tax year. Think of it like a checklist. Number 1, it has to be private. Number 2, a Canadian resident. 3, can't have shares listed on a stock exchange. And 4, the big one, control cannot be in the hands of non-residents or public companies. You miss even one of these and you're out. It's that simple.
So let's really focus on this idea of control, because trust me, it's way more complex than just looking at who owns the most shares. The Income Tax Act actually looks at control in two very distinct and important ways.
On one hand, you've got legal control, or de jure control. This is the straightforward one. It's control in law, who has the majority of votes to elect a board of directors. But the Act also considers factual control, known as de facto control, and this is a much broader test. It looks at any kind of influence, direct or indirect, that could result in control, even if you don't own the majority of shares. So let's look at a classic scenario here. A private Canadian corporation is split exactly 50-50 between Canadian residents and non-residents. So is it a CCPC? And the answer is yes. Now, why is that? Well, because no single group has de jure control. The non-residents don't have more than 50% of the votes, so they don't legally control the company. Pretty interesting, right? Okay, this next one is a perfect example of indirect control. So Corporation B is 100% owned by a Canadian company, Corp C. Seems okay so far, but Corp C is 100% owned by a non-resident. The Canada Revenue Agency looks right through the entire ownership chain, and because control ultimately rests with a non-resident, Corporation B is not a CCPC. You gotta follow the chain of command.
All right, now that we've got the rules down, let's get to the good stuff. Let's talk about the powerful benefits. This is why a CCPC status is so incredibly sought after, and it's why your future clients are going to depend on you to get it and keep it for them.
This number right here, this is the key, 9%. This is the federal tax rate for the small business deduction, and it is, without a doubt, the single most important tax advantage for a CCPC.
So, the Small Business Deduction, or SBD, lets a CCPC pay a federal tax rate of just 9% on its first $500,000 of active business income. I mean, that is a massive advantage compared to the general corporate rate of 15%. That tax saving means better cash flow, which means more money for reinvestment and growth. It's huge. And for innovative companies, the benefits for scientific research and experimental development, well, they're immense. A CCPC gets an enhanced 35% tax credit, and this is the critical part. It's refundable. Refundable means the government sends you cold, hard cash even if you don't owe any tax. For a startup, that can be a literal lifeline. Now this is a life-changing number for a lot of business owners. As of January 1st, 2025, an individual can shelter up to $1.25 million in capital gains from tax when they sell the shares of a qualified small business corporation, which, you guessed it, is almost always a CCPC. CCPCs also have a major advantage when it comes to attracting top talent. You see, when an employee exercises stock options, the tax is deferred until they actually sell the shares. Now compare that to a public company where the tax is often due right away.
This deferral lines up the tax bill with the cash-in-hand event for the employee, making stock options an incredibly powerful tool.
But of course, it's not all sunshine and rainbows. These benefits, especially the SBD, they are not unlimited. And as future advisors, you absolutely have to understand the hazards. One of the biggest is something we call the passive income grind.
I want you to burn this number into your memory, $50,000. This is the annual passive investment income threshold. If a CCPC and its associated corporations earn more than this in a year from stuff like rent, interest, or portfolio dividends, it starts to eat away at their small business deduction for the next tax year.
This table shows you exactly how it works. For every single dollar of passive income over that $50,000 mark, the $500,000 SBD limit gets reduced by $5. So you do the math. At $150,000 of passive income, the SBD is completely gone for the year. This rule is basically the government's way of encouraging businesses to reinvest in their active operations, not just hoard passive investments.
Okay, now we come to the ultimate hazard. This is the one you'll work hard to help your clients avoid at all costs: losing CCP status altogether. The moment a corporation stops being a CPC, let's say a non-resident buys a controlling stake, that corporation's tax year is deemed to end on the day right before that change. In this single event, it triggers immediate and really significant consequences.
And the consequences are severe, and they cascade. The small business deduction? Gone, instantly. The ability for shareholders to use that $1 million+ capital gains exemption on a future sale? Vanishes. Those enhanced refundable SR&ED credits? Reduced. And that deemed year-end we just talked about, well, it creates an extra tax filing, and it can speed up the expiry of valuable loss carry-forwards. This is a scenario that demands careful, proactive planning.
All right, for our last section, let's zoom out. Let's connect all these practical rules to the key theory that underpins the entire system for private corporations in Canada, and that principle is called tax integration.
Tax integration is this core idea that an individual should, at least in theory, pay about the same total tax whether they earn income personally or through a corporation. And for CCPCs, there are two sort of notional accounts that are absolutely crucial for making this theory a reality.
The first is the Refundable Dividend Tax on Hand, or RDTOH. This helps integrate tax on investment income. The second is the Capital Dividend Account, or CDA. This tracks tax-free amounts, like the non-taxable half of a capital gain, and allows them to be paid out to shareholders completely tax-free. These are incredibly powerful mechanisms you are going to use constantly in practice.
This quote, it really just perfectly summarizes the role you are all going to play as tax advisors. CCPC status is not a set-it-and-forget-it kind of thing. It's not automatic. It requires diligent, proactive management for the entire life of a business.
So this is the crucial point, and it's what I really want you to take with you from our session today. Is CCPC status just some static label you get when you incorporate? Or is it a dynamic strategy that you have to actively manage and protect throughout the entire life of a business? Your answer to that question is what will define your value as a tax practitioner.